Let's start with what everyone thinks is happening, because I want to be fair to these arguments before I dismantle them. Narrative number 1, it's retail demand. The story goes like this. Reddit stackers, YouTube viewers, small investors around the world have woken up to the value of physical silver. They're buying coins, bars, rounds. Dealers are seeing record sales. Mints are back ordered. Therefore, retail demand is driving the price. Sounds logical, right? There's just one problem. Retail demand has been elevated for years. Go back to 2020, 2021, the silver squeeze movement. Retail was buying hand over fist. Did the price explode to $100? No, it got smacked down from $30 to $22 and stayed there for years. If retail demand was the driver, we would have seen this move years ago, but we didn't. Something else changed. Narrative number 2, it's inflation hedging. This one's a classic. Inflation is running hot, real rates are negative, investors are rotating into hard assets to preserve purchasing power. Silver, being a monetary metal, benefits from this rotation. Again, sounds reasonable. But let me ask you something. Inflation has been elevated since 2021. Real rates have been negative for most of the last 4 years. If inflation hedging was the primary driver, where was silver when CPI was printing 9%? It was sitting at $24 an ounce, while the financial media told you inflation was transitory. The inflation narrative doesn't explain the timing. Inflation was worse 2 years ago than it is today. So why is silver moving now? Narrative number 3, safe haven demand during geopolitical crisis. Wars in Ukraine, tensions in the Middle East, trade wars with China, political instability everywhere you look. Investors are scared, so they're buying precious metals. This narrative has the same problem. Geopolitical tensions have been elevated for years. The Ukraine war started in 2022. The Middle East has been a powder keg since, well, forever. None of these events are new. So I'll ask again, why now? What changed? This is the question nobody is asking, and the answer is the key to understanding everything that's about to happen in the silver market. Here's what changed, and I need you to really focus on this because it's the most important thing I'm going to tell you. For the last 40 plus years, the price of silver has been determined primarily by paper markets. The COMEX in New York, the LBMA in London. These are futures and forward markets where silver is traded as contracts, pieces of paper that represent silver but rarely result in actual physical delivery. On any given day, the paper market trades the equivalent of 500 and 800 million ounces of silver. That's more than an entire year's worth of global mine production, traded in a single day. Now here's the kicker. The COMEX has roughly 30 to 35 million ounces of registered silver available for delivery. The LBMA's actual physical holdings are notoriously opaque, but estimates suggest similar constraints. Do the math. The paper market trades 25 times more silver daily than exists in registered inventory. This is not a physical market. This is a casino where the house, the bullion banks, the market makers, controls the price through leverage, naked shorting, and settlement in cash rather than metal. This system works as long as everybody plays along. As long as futures traders settle in cash. As long as nobody actually demands the physical metal. But here's what's changed. The physical markets are no longer playing along. Shanghai, Dubai, Mumbai, Singapore. These markets are now paying significant premiums over COMEX spot price. And these premiums aren't small. We're talking 15%, 20%, sometimes 30% higher than what New York says silver is worth. Why? Because in these markets, you don't get to settle in paper, you settle in metal. And when you have to deliver actual physical silver, suddenly the spot price, set by COMEX, becomes irrelevant. This is the migration of price discovery, and it's the real driver of what you're seeing in silver. Let me give you the receipts, because I know some of you are skeptical. Good. You should be. Verify everything I'm telling you. Evidence. Point 1. Shanghai Premium. The Shanghai Gold Exchange, which despite its name also trades silver, has been showing persistent premiums over London and New York for months now. As of recent data, Shanghai silver has traded at $10, $50, even $20 per ounce above Western spot prices. Think about what that means. An arbitrageur, someone who exploits price differences between markets, should be able to buy silver at $30 on COMEX, ship it to Shanghai, and sell it for $45. Free money, right? But they're not doing it. Why? Because they can't get the physical metal? The COMEX doesn't have it. Or if they do, the delivery process is so slow and bureaucratic that the arbitrage window closes before you can execute. When arbitrage fails to close a price gap, it tells you something fundamental. The lower price is artificial. It doesn't reflect actual supply and demand for physical metal. Evidence point 2, Indian import premiums. India is the world's largest consumer of silver for jewelry and industrial purposes. Indian dealers are currently paying premiums that would make your head spin, Reports of $40, $50 per ounce above Western spot are not uncommon. Again, if silver was readily available at COMEX prices, Indian importers would be all over it. They're not stupid. They're paying massive premiums because they have to. The metal at Western spot prices simply isn't available in the quantities they need. Evidence point 3. Dubai physical market. Dubai has emerged as a major hub for physical precious metals trading. The Dubai Gold and Commodities Exchange deals in actual metal, not paper promises, and their prices increasingly diverge from COMEX. When the physical market consistently prices an asset higher than the paper market, it tells you that the paper market is mispriced. It's not reflecting reality, it's reflecting a controlled narrative. Evidence. Point 4. COMEX delivery demands. Here's where it gets really interesting. Look at the delivery notices on COMEX. Look at the stopping. Data. How many contracts are standing for physical delivery rather than rolling over or settling in cash? These numbers have been trending up. More and more traders are saying, I don't want your cash settlement, I want my silver. When this happens at scale, the paper market breaks. Because remember, they're trading 20x more silver than they have. If even 5 or 10% of contract holders demand delivery, the math doesn't work. This is the slow motion bank run happening right now in the silver market. And it's why price discovery is migrating east. Now let me explain the mechanism, because understanding how this works will help you see where it's going. The paper market suppresses silver prices through a simple technique: unlimited selling of contracts that don't represent actual metal. Here's how it works. Let's say silver is at $30 and starting to rise due to physical demand. A bullion bank, let's call them JP Morgan, just for fun, can sell 50 million ounces worth of paper silver contracts in a matter of minutes. They don't have 50 million ounces. They're selling promises to deliver silver they don't possess. This is called naked shorting, and in any other market it would be illegal. But here's the key. As long as the buyers of those contracts don't demand physical delivery, it doesn't matter. The bank can settle in cash. They sell at $30. The price drops to $28 from the selling pressure. They buy back their contracts at $28. Pocket the $2 difference, and nobody ever asks for metal. This game works when the market is dominated by speculators who don't want physical silver, hedge funds, algo traders, momentum players. They're just betting on price movements. They don't care about the metal. But the game breaks when physical demand overwhelms the paper structure. What's happening now is that physical buyers, industrial users, Eastern central banks, sovereign wealth funds, and yes, retail stackers are draining actual metal from the system. Every ounce that leaves a COMEX vault, every bar that ships to Shanghai, every coin that goes into a private safe, that's metal that can't be used to settle a delivery demand. As registered inventory falls, the paper market's ability to suppress price diminishes. They can sell all the paper contracts they want. But if someone calls their bluff and demands delivery, they have a problem. And increasingly, people are calling their bluff. Now, I know there are different people watching this with different perspectives. Let me address each of you directly. Type 1, the long-term stacker. You've been buying silver for years, maybe decades. You've watched the price get manipulated. You've seen the smackdowns. You've endured the ridicule from friends and family who think you're crazy. Here's what I want to tell you. You were right. Not early, right. The thesis was always correct. The only variable was timing. The paper suppression scheme was more durable than many of us expected. But durability is not immortality. Every suppression scheme eventually breaks. And this one is breaking now. Don't let the volatility shake you out. Don't let a 10% pullback convince you the move is over. The structural shift I'm describing doesn't reverse. Once price discovery migrates to physical markets, it doesn't migrate back. Type 2, the new investor. Maybe you found this channel recently. Maybe you're just starting to understand precious metals. You're looking at silver's recent move and wondering, is it too late? Here's my answer. You're not early, but you're not late. You're on time. Think about it this way. If silver is transitioning from a paper-controlled price to a physical determined price, we're maybe in the second inning of that transition. The Shanghai Premium tells you the physical market thinks silver is worth far more than 32 hours or 35. The arbitrage should close that gap, but it can only close by the Western price rising to meet the Eastern price. You have a window. It's not as wide as it was 2 years ago, but it's still open. Use it. Type 3, the skeptic. You think this is all conspiracy theory nonsense? Silver is just a commodity. Supply and demand determines price. Markets are efficient. The COMEX is regulated. This manipulation talk is just cope from people who bought too high and are waiting to break even. I respect the skepticism, but I'd ask you to consider something. If markets were efficient, why does silver trade at dramatically different prices in different locations? Efficient markets arbitrage away price differences instantly. The fact that Shanghai is paying 20% more than New York for the same metal tells you something is broken in the price discovery mechanism. If COMEX was functioning properly, why is registered inventory at multi-decade lows while open interest remains elevated? Where's the silver backing all those contracts? And if there's no manipulation, why has JP Morgan paid nearly $1 billion in fines for spoofing and manipulating precious metals markets? They admitted to it. This isn't theory. It's settled legal fact. I'm not asking you to believe me. I'm asking you to look at the evidence and draw your own conclusions. Let's name names because this isn't abstract. Real institutions benefit from suppressed silver prices, and they've been profiting from this scheme for decades. The bullion banks JP Morgan, HSBC, Bank of America. These are the market makers on COMEX. They hold massive short positions that profit when silver falls or stays flat. They have the capital and the market access to execute the suppression trades I described earlier. JP Morgan, in particular, is interesting. They've been fined repeatedly for precious metals manipulation. They have a trading desk that was literally nicknamed the spoofing desk by internal employees. And yet they continue to operate as a primary market maker. Why? Because the fines are a cost of doing business. When you're making billions from suppression and the fine is $920 million, that's just a tax on profits. The Federal Reserve and Treasury. This one's more indirect, but no less important. A rising silver price signals a loss of confidence in the dollar. Throughout history, precious metals have been the canary in the coal mine for currency debasement. The Fed has every incentive to keep gold and silver prices suppressed, not through direct trading, that would be too obvious, but by allowing the bullion banks to operate with minimal oversight and slap on the wrist penalties. Remember, the Fed doesn't answer to you. It answers to the banks, and the banks profit from suppression. The paper ETF complex SLV, the largest silver ETF, has a custodian, guess who? JP Morgan. The same bank that has been fined for silver manipulation is responsible for holding the physical silver that supposedly backs the paper ETF. I'll let you draw your own conclusions about how much silver actually sits in those vaults. Speaking of people who get it wrong, I have to take a moment to appreciate Jim Cramer. If you're not familiar with the inverse Cramer indicator, here's how it works. Whatever Jim Cramer recommends, do the opposite. It's become so reliable that people have actually backtested it and found it outperforms most hedge funds. Cramer has been bearish or dismissive of precious metals for most of the last decade. Every time gold or silver has made a significant move, he's either missed it or told people to sell. The man has an almost supernatural ability to be wrong at the exact moment it matters most. If being wrong were an Olympic sport, Cramer would have more gold medals than Michael Phelps. So when I see Cramer still lukewarm on silver, I take that as a very bullish signal. The day he turns enthusiastically bullish is probably the day to take some profits. Until then, we ride. I know some of you find these Cramer segments entertaining. Others think I'm being too harsh. But honestly, when someone has been as consistently wrong as he has, while collecting millions of dollars to give financial advice, a little mockery seems appropriate. Moving on. All right, let's talk numbers. Where is silver going and on what timeline? First, let me be clear. I'm not a fortune teller. I can't give you exact prices on exact dates. Anyone who claims they can is lying to you. What I can do is describe the structural setup and what it implies for price. Near term, $50 to $65 within 12 months. If the current trajectory continues, if physical premiums remain elevated, if COMEX inventory continues to decline, if delivery demands continue to rise, we should see silver break $50 within the next year. $50 is a psychological level. It's the 2011 high that was never reclaimed. Breaking through it will generate significant media attention and bring in a wave of momentum buyers. From there, $65 is the next logical target. That's roughly where the gold-silver ratio would normalize to around 50.1, with gold at $300. Medium term, 100 plus, within 36 months. If the migration of price discovery accelerates, if we see a COMEX delivery failure or a major bullion bank capitulate on their short position, or a large institutional buyer demand physical that can't be sourced, the move to $100 becomes very realistic. At $100 silver, the gold-silver ratio would be around 35.1, with gold at 30,500. This is well within historical norms during precious metals bull markets. Long-term, genuine price discovery, 150, 300 plus. If paper markets completely lose control and silver is priced purely by physical supply and demand, we're in uncharted territory. Consider the average smartphone contains about 0.3 grams of silver. There are 1.5 billion smartphones sold annually. That's 450,000 kilograms, or about 14.5 million ounces, just for smartphones. Solar panels use approximately 20 grams of silver each. Global solar installation targets require hundreds of millions of panels annually. Electric vehicles, 5G infrastructure, medical devices, water purification, silver is critical to all of them. And mine supply has been flat for a decade, while these industrial demands have exploded. When the paper suppression scheme fully breaks, price will need to rise to a level that either rations demand or incentivizes massive new supply. Neither happens at $35, neither happens at $50. Genuine equilibrium might require triple-digit silver. I'm not saying this happens overnight. I'm saying the structural conditions for it are now in place. All right, let's talk numbers. Where is silver going, and on what timeline? First, let me be clear. I'm not a fortune teller. I can't give you exact prices on exact dates. Anyone who claims they can is lying to you. What I can do is describe the structural setup and what it implies for price. Near term, $50, $65 within 12 months. If the current trajectory continues, if physical premiums remain elevated, if comics inventory continues to decline, if delivery demands continue to rise, we should see silver break $50 within the next year. $50 is a psychological level. It's the 2011 high that was never reclaimed. Breaking through it will generate significant media attention and bring in a wave of momentum buyers. From there, $65 is the next logical target. That's roughly where the gold-silver ratio would normalize to around 50.1 with gold at $3,300. Medium term, 100 plus. Within 24 or 36 months. If the migration of price discovery accelerates, if we see a COMEX delivery failure or a major bullion bank capitulate on their short position, or a large institutional buyer demand physical that can't be sourced, the move to $100 becomes very realistic. At $100 silver, the gold-silver ratio would be around 35.1 with gold at 3,500. This is well within historical norms during precious metals bull markets. Long-term, genuine price discovery, 150, 33, and 200 plus. If paper markets completely lose control and silver is priced purely by physical supply and demand, we're in uncharted territory. Consider, the average smartphone contains about 0.3 grams of silver. There are 1.5 billion smartphones sold annually. That's 450,000 kilograms, or about 14.5 million ounces, just for smartphones. Solar panels use approximately 20 grams of silver each. Global solar installation targets require hundreds of millions of panels annually. Electric vehicles, 5G infrastructure, medical devices, water purification, silver is critical to all of them. And mine supply has been flat for a decade while these industrial demands have exploded. When the paper suppression scheme fully breaks, price will need to rise to a level that either rations demand or incentivizes massive new supply. Neither happens at $35. Neither happens at $50. Genuine equilibrium might require triple-digit silver. I'm not saying this happens overnight. I'm saying the structural conditions for it are now in place. Let me bring this back to where we started. Silver didn't rally because of retail demand, although retail demand helped. It didn't rally because of inflation hedging, although inflation is real. It didn't rally because of safe haven flows, although the world is increasingly uncertain. Silver rallied because the paper suppression scheme is breaking. Price discovery is migrating from New York to Shanghai. Physical premiums are blowing out. Delivery demands are rising. Registered inventory is falling. The arbitrage that should connect paper and physical markets is failing. These are not temporary dislocations. These are structural shifts in how the silver market functions. When a 40-year-old manipulation scheme breaks, the repricing is not gradual. It's violent and disorienting. It feels too fast and overdone at every step, until you look back and realize it was inevitable. We are in the early stages of that repricing. The real driver is not any single narrative. It's the breakdown of the false narrative that paper markets told for decades. Silver is being repriced to physical reality. And physical reality says silver is worth far more than $35. Stay the course. Hold physical, ignore the noise, and I'll see you in the next one.